There's an emerging divide at the Federal Reserve.
This is generally a consensus-driven committee. Consensus is not there right now.
It's a high-stakes difference of opinion. The Fed's leaders set an interest rate that can affect your job prospects, your home's value, and the cost of virtually all financial products.
We're talking about mortgages, talking about credit cards, car loans, all those kind of things that people use over the course of their daily lives. What is important to know is the directionality of what that rate is. Is it going up? Is it going down?
Recent projections show the federal funds rate falling over the coming years.
I think there's also politics playing a role here. There are some people who are up for consideration to be the next Fed chair, and they wanted to perhaps project a more dovish view to our president who wants lower interest rates.
Here's how the Federal Reserve tries to predict the future path of interest rates. We learn about where the Fed thinks it will take interest rates on a chart called the dot plot.
There are 19 Fed officials who attend every Federal Open Market Committee meeting. The dot plot specifically asks them each to say, where do you think interest rates are going to be this year? Where do you think they're going to be next year? Where do you think they're going to be the year after that? And the year after that, and often to the future, like where do you see kind of rates stabilizing at? The forecasting power of this dot plot several years into the future, the history of it not particularly good, but it's still something that we hang our hats on.
Forecasting is really hard, especially when it comes to the future. They did definitely have a series of mistakes that were made in the pandemic and beyond it. But before that, they've had a pretty decent record of predicting where inflation would go. Not a bad record on predicting growth or unemployment. They do have a pretty bad record of predicting interest rates, which is interesting.
The most recent plot reveals that interest rates are likely to fall over the next 2 years, reaching 3.12% by the end of 2027.
If the dots are shifting lower, it means that the cost of borrowing is going down. And we live in an extremely leveraged society, which means that we have a lot of debt. So when the cost of credit and the cost of money gets lower, that creates easier financial conditions. So if you're a company and you have to pay less interest on a loan, it's going to make you more inclined to invest in your business. It's going to make you more inclined to hire people.
The dot plot is updated 4 times per year and published in the Summary of Economic Projections, which forecasts future conditions.
That's done through 3 metrics, through gross domestic product, through inflation, and through the unemployment rate. The argument for holding rates steady right now comes from a faction on the committee that is still concerned about inflation.
You have people who think that, the Fed has been missing on the inflation target for 4 going on 5 years, and it's right to remain somewhat restrictive and drive down inflation back towards the 2% target.
The other argument that you're getting from within the Fed for lower rates are concerns about the labor market.
Here, the Fed is making decisions without vital official information due to the government shutdown. Economists instead are relying on alternative data.
Employment data has been weak. The ADP data has been negative in 4 of the past 6 months. On the other hand, all of that speaks to some layoffs, but the jobless claims numbers have been very well behaved. So what we think we're in right now is a low hire, low fire environment in which the unemployment rate is expected to tick up, but tick up only gradually and not surge.
The worries are that we could stay in the no hire market and start to get into actually some firing, and there are signs of some considerable layoffs coming.
And I think, I call him too late. Jerome, too late. Powell, he's too late. He's too late always. He always has been.
Through 2025, President Trump has attempted to get the Fed to cut rates faster.
The administration prefers low interest rates for a number of reasons. I think one of them is some substantial worries about the housing market.
Lower mortgage rates could make it cheaper to finance a home, but those rates are pegged to yields on longer-term bonds, like the 10-year Treasury. They don't always follow the federal funds rate.
This is a big concern for the Fed. It does not want to see the market moving in an opposite way of which way it's heading. The Fed needs the markets, longer end bonds, to do its bidding.
A lower Fed policy rate could also lower the government's borrowing costs.
Another reason that President Trump has cited, he hasn't talked a lot about it lately, but the concerns over our national debt. And of course, financing costs running north of $1 trillion a year.
Of the 12 voting committee members at the Fed, 7 of them are presidential appointees who served 14-year terms. 3 sitting governors were appointed by President Trump.
There's the potential, though far from certainty, that President Trump will have another appointment or two to the Board of Governors.
Then there's the face of the Fed, the chair.
The Fed is a institution that has been typically or traditionally heavily led by the chair. I think there is some deference on the part of committee members, and they'll say, if I'm on the fence or I could go either way, I would go with the chair.
Jerome Powell's term as chair is up in mid-May 2026.
I think that there's a very good chance that the president will make an announcement before Christmas.
You know, the odds-on bet right now is that it's Kevin Hassett, the president's National Economics Council director. If he comes in and it is that he wants to do the bidding of the president who wants lower rates, then that will matter a lot. We'll see if the committee itself can be a stopgap on that drift.